So we're going to discuss financial markets. All right. Financial market is part and parcel of the financial system. But what do we mean when we say financial market? Maybe before we start discussing the financial market, let's just say, what is a market? Okay. What is a market? A market simply means a place where buyers of goods and sellers of goods and services meet for exchange. Okay. Therefore, at the market brings together two types of individuals. Okay, buyers and sellers. All right. Now, buyers have money. That means they demand to purchase certain goods or services. On the other hand, sellers are there either to offer certain goods or services. All right. And what takes place there we call the exchange. All right. They exchange goods and services for money. Now, there are a lot of markets. Okay, if someone asks you different types of markets, there are varieties of markets. I'm not really sure if we can mention them, and finish them. But just to mention the list, all right, there is, for example, grain market. All right, then there is beverage market. All right, there is livestock market. Right, but also there is financial market. So what is the difference between these markets? The difference relies on the type. Okay, the difference relies on the type of product that is traded. Okay, type of product traded is what defines the category of the market. But as I've mentioned, I've just said before, there are a lot. I cannot mention them all. Right now, in this module, our focus is on the financial market. This is a special type of the market. Some unique products are being traded at this market. All right, so we are going to focus on only this kind of market. Forget the rest of the market. Okay, now how do we define a financial market? Financial market simply means a place where financial securities are traded or they are exchanged. Okay, a place where financial securities are traded or are exchanged. So basically, the financial market offers a platform. All right, financial market offers a platform for trading of financial securities. All right, if you have any kind of financial security, for example, a bond, okay, stocks, mortgages, debentures, treasury bills, commercial paper, certificate of deposits, okay, etc. And for some reasons you want to float them, you want to sell them, then the right place for you to go is not at the grain market, but at the financial market. That is the right place for you to visit. All right. Now, we mentioned that at the financial market, financial assets or securities are traded. So here we have something new to define: financial security or financial asset. What is a financial security or what is a financial asset? A financial security, also known as the financial asset or financial instrument, simply means an asset that represents a claim in the issuer's future income. Okay, look, this is an asset that represents a claim. Okay, very important to comprehend. Financial assets represent a claim. A claim on what? A claim on the future income of the issuing firm. That is to say, for example, if you own a certain financial market, if let's say you are a bond holder, okay, if you're a bond holder, it means the company or the firm that issued this particular bond owes you some money. Okay, this firm owes you some money. That is to say, this firm will have to make some periodical payment. Okay, it has to make some periodical payment until maturity of this particular bond. Shortly, we're going to have a detailed discussion on bonds, equities, plus some other financial assets. All right. All right. Basically, at the financial market, funds are transferred from people who have an excess, okay, available funds to people who have shortage. All right. Remember what we call financial intermediation. Remember financial intermediation. Okay. We say financial intermediation is the process of channeling funds from the surplus spending unit to the deficit spending unit of the economy. So actually, even the financial market performs this particular function, financial intermediation. That is, it channels funds from surplus spending unit of the economy to the deficit spending unit of the economy. All right? Now, by doing so, the financial market is playing a very huge role of promoting greater economic efficiency. How? Through channeling of funds. That is effective allocation of resources. All right? We have individuals who have funds, but they don't know how to use them. On the other hand, we have individuals who have idea, who have factories, industries, they are producing goods and services, but apparently they do not have sufficient funds. So through financial markets, funds can reach to these individuals, and these individuals, the individuals who have ideas for production, like they have industries, they have factories, they can produce goods and services, will use those funds for productive activities. So this is how we go. Assume that here we have this one small economy, okay, and on one side you have individuals or different units of the economy that have a lot of funds, okay, a lot of funds all over. So financial markets assist channeling of these funds from these individuals to the deficit spending unit of the economy. Here we're talking of some companies, okay, the government, etc. Who, for example, if it's a company, the company will take this fund and go to produce some goods and services, of which these goods and services are going to be offered within the very same economy, offered for sale, okay? And once these goods are bought, what will happen? Okay, first of all, these individuals who initially provided funds are the one who will purchase these goods and services, okay? And through the profit that these companies will make, the companies will be able to meet their obligations, such as paying taxes, government levies, but also repaying back their contractual financial obligation, such as bond payment. If not bond payment, then let's assume it's a loan, then loan repayment, or dividend. All right? That's how it plays. By doing so, this economy will no longer be small. This economy will continue to grow. The economy will continue to grow. That's what's gonna happen. All right. Therefore, a well-functioning financial market is a key factor in producing high economic growth, while actually a poor performing financial market is the reason for a lot of economies to continue to be poor. Now here I have a summary of what I've just said. That is, in any given economy, there are two economic agents: the deficit spending unit and the surplus spending unit. All right. Therefore, deficit spending unit simply means all economic agents that have shortage of funds, whereas the surplus spending units, this means the economic agent that have extra funds. As I mentioned earlier, the deficit spending units can be the government, all right, can be some companies, can be some individuals. All right. On the other hand, surplus spending unit can be individuals like the citizens, can be foreigners, okay, people from different countries, all right, can be the government, all right, can be some companies or corporations. So what happened is the financial markets connects these two economic agents where deficit spending units issues financial instruments. And what are the financial instruments issued here? Depending with the category of the financial market, the instruments can be commercial paper, can be certificate of deposits, right? Can be treasury bills, can be treasury bonds, can be corporate bonds, etc., etc. So there are different types of financial instruments. Now, once the deficit spending units have issued any of these financial instruments, the surplus spending unit will acquire them by making payments. That is, they offer funds. Okay. So funds will flow toward the toward the deficit spending unit. However, this fund will not be claimed just as it went. This fund will have to generate a certain interest. So by the time the deficit spending unit is repaying back the borrowed funds, then it will have to pay with a certain interest as per the agreement. That is to say, all these financial assets that I have mentioned here will yield some sort of return or profit to the surplus spending unit of the economy. Each financial market is created to satisfy particular preferences of market participants. Okay? Each financial market is created to satisfy particular preferences of market participants. Maybe before we discuss even further, before we get further deeper into our discussion, let's see who are the market participants, right? Who are the participants? Who are the major participants in any financial market? The first participant is supposed to be institutional investors, all right? The first participant is institutional investors. Institutional investors, this is a collective term, okay? This is a collective term for commercial banks, insurance companies, and also pension funds. So collectively, we call them institutional investors. These are the first participants of the financial market. But second participants are multinational companies. Okay, multinational companies. Multinational companies. All right, these are companies that have their headquarters outside of our countries, and for some reasons they've been listed in our financial markets, so they are over there selling various financial securities in order to raise what? In order to raise capital. All right, but also we might have domestic companies or corporations. Okay, again we have individuals. All right, we have individual investors. We have individual investors. Now, individual investors can be you and I. Okay, these can be either citizens of the same country or can be citizens of different countries. Call them foreigners. All right, and also within individuals, we expect to have these special people who really participate in the market, that is a broker and dealers. All right, brokers and dealers. Again, these are very, very important. Okay, now broker and dealers can be individuals, but also can be some companies or firms, or can be firms or can be individuals. So if it's a firm, then might be a firm that deals with brokerage services, or it offers brokerage services. Okay, buying and selling of securities is very possible, or bringing together investors who wants to buy these financial assets at the market. Dealers, sometimes they bring together people who wants to buy and sell financial instruments, but sometimes they buy these assets at their own account, and later on they might decide to release them, like to sell them. So it depends with the position. If they deem that the security is more profitable and they have sufficient capital, they may decide to buy those particular securities instead of selling them. I mean, instead of bringing someone else to come and buy. So that is to say, if you have a certain individual here who own some assets, financial assets, for instance, bonds, and now he wants to sell this bond, okay, it will be difficult for him to come across another individual or another investor who is willing to purchase this bond. So for you not to suffer, what you have to do is you can go to one of these companies that offer brokerage services. So you can go to the broker or you can go to the dealer. All right, these will be the one to connect you with another investor who is interested to buy the bond that you want to sell. So what do they receive from their service? They receive commission. Okay, they receive commission. Companies. Why are companies over there? Companies, I mean now multinational company or domestic companies. Why are they participating in the financial market? They are over there to raise capital. All right, they are into the financial market in order to raise capital. So If you know, for example, there's what we call capital structure. Okay, capital structure of any company can be in two different ways, or let me say three. Capital structure can be debt capital, okay, can be equity capital, or can be mixed capital. Mixed capital, that means a fraction is debt and fraction is equity. Whereas debt capital, that means 100% is debt. It can be a loan from a bank or fundraised from what? Borrowing, maybe in form of selling of bonds. On the other hand, equity capital, that is raised from what? From equity, shares. All right? From equities, shares. Therefore, these instruments, okay, the equity or bonds, are sold or are issued by multinational companies or any company at the financial market. And by issuing them, it means they are the source for the company to raise capital. Sometimes the government, government's supposed to offer free public goods and services. All right, the government is supposed to offer free public goods and services. And to be able to do so, the government requires a lot of funds because the government always embark into massive projects. Okay, so these projects requires funds. That is the reason now the government can issue treasury bills or treasury bonds. Okay, the government can issue treasury bills or treasury bonds. Okay, a bond that is issued by companies, all right, is called corporate bond. All right, it's called corporate bond. A bond that is issued by the government is called the treasury bond. Therefore, the government can realize funds to finance its massive project following the selling of treasury bills or treasury bonds. Call them government securities. And one of the major customers of the government securities are the institutional investors. Okay, institutional investors, because government securities are almost risk-free. They pose very, very little risk. We do not expect for a government to default, but corporate bonds are highly risky. That is the reason you'll find a corporate bond of the same maturity as the treasury bond will pay different interest rate. I say again, a corporate bond of the same maturity as the treasury bond pays different interest rate. Actually, the interest rate paid by the corporate bond will be relatively higher, greater than the one paid by the treasury bonds. Why? Is due to risk. However, there are some other issues such as tax consideration, but the degree of risk. The higher the risk, the higher the return. So the higher the risk, investor will want what? Will want to be paid some more. Okay. As for individual investors, they improve their living standard by buying these financial assets traded. If you buy bonds, you'll receive coupon payments to the maturity of the bond. That means you'll be making money. I've already mentioned about broker and dealers. They receive commission for their work. So, gentlemen, ladies, these are the participants of the financial market. Now, each financial market is created to satisfy particular preferences of market participants. Why? Because there are some of the participants will want to borrow in short term and some in long term. Okay. Likewise, individual investors or investors are willing to invest their funds for short term, and others are willing to invest for long term. Okay. Again, there is a degree of risk tolerance. Remember, when it comes to the issue of risk, we have risk averse, we have risk lovers, and we have risk neutral. Risk neutral are indifferent, like whichever comes their way, it's okay. Risk averse, they are scared of risk. Okay, they are scared of risk, so they are very cautious. If they deem that a certain investment poses too much risk, they will better stop from investing into that particular asset. And what about risk lovers? They are not scared of risk. Okay? Risk lovers are not scared of risk. Why? Because they believe that a risk asset is the one that can yield supernormal profit, high return. Remember, the higher the risk, the higher the return. So individuals such as speculators fall into this category. Therefore, depending with the willingness to tolerate high level of risk, also we may categorize financial market based on that particular category. Again, some participants of the market prefer to borrow, that is, they may go for syndicated loan or they may issue what? Bonds. Whereas some participants simply want to invite others to be partners in their businesses, to become shareholders, and so they issue what? They issue shares or equity. Now, one of the most popular classifications divides the financial market into individual submarkets according to type of financial instrument that is traded. Okay. Sometimes we can divide these markets following the type of financial instrument that are traded. That brings us to categories such as the stock market, corporate bond market, treasury bill market, commercial paper market, and so forth. Okay. And another theory categorizes market based on maturity of assets traded. All right, based on maturity of assets traded. That is to say, there are some assets have shorter maturity, whereas some other assets have longer maturity. So these are different ways at which financial markets can be classified or categorized. Okay. Now, let's start with the money market. Okay, let's start with the money market. What is a money market? Money market is a type of financial market where financial instruments whose maturity does not exceed 1 year are traded. Okay. The money market offers a platform for buying and selling of financial assets whose maturity is less than 1 year. That is to say, if the asset that you possess has longer maturity, has a maturity that exceeds 12 months, then the money market is not the right place for you to trade that particular asset. You need to look for another category of the financial market, because here it is straightforward that maturities, financial assets that are traded in this platform needs to have shorter maturity. So in most cases, the money market is used by corporations or by companies to raise funds in order to meet business recurring expenditure or working capital financing. Okay, this market is for working capital financing. If you are looking for funds to meet short-term funding needs, like purchasing of raw materials, okay, purchases of raw materials, payment of salaries, wages, per diem, okay, payment of utility bills, these are all short-term funding needs falling under the category of working capital. Then the money market is the right place for you to approach in order to raise that particular funds. Okay. Now, what are the instruments that are traded at the money market? The instruments that are traded at the money market, first, they all have exactly the same characteristics. That is, they have shorter maturity. Maybe before I mention this instrument, okay, before I mention this instrument, let me first discuss with you characteristics or attributes of instruments that are traded at the money market. Okay, what are the common characteristics? Okay, what is the common characteristics of instruments that are traded at the money market? Number one, they are high liquid. Okay, they are high liquid. Number two, they have shorter maturity. And number three, they have low return. Okay, they have low return. And actually, these attributes also defines the characteristics or the general characteristics of the money market. Okay, the money market is high liquid, but it generates low return. And so are the instruments traded in this particular market. Why are they high liquid? They are high liquid because they are less risky. Okay, let me add it here. Okay, less risky. They are high liquid because of they are less risky and their maturity is not long. They have a shorter maturity. Take an example. Someone asks you to lend them money under the promise that they're going to pay you within 7 days. And someone else asks you to lend them exactly the same amount of money and they're going to pay you back within a single day. Okay? From these two borrowers, you can see that one contract is more riskier, than the other one. The degree of risk here is greater than the degree of risk on the second proposition. One day, in the matter of only 24 hours, you get back your money. 7 days is too much. And therefore, following the amount of risk under this first contract and this second contract, following the amount of risk under the first contract, automatically you will want to charge higher interest rate. So, let me give you a practical example. If I'm to give you a practical example, that is, consider the following instrument. Consider a bond that has a maturity of 2 years and consider a treasury bills that has a maturity of 90 days. Okay, if both instruments, have the same face value, that is, let's say 10,000, okay, the interest or the profit that you generate if you are to invest in a 90 days treasury bill will be less, okay, will be less than the profit that you generate if you are to invest the exact amount in a 2 years bond. Why? Because of the degree of risk. Bond is riskier than the treasury bills. However, when it comes to the issue of liquidity, the treasury bills is high liquid. Anyone will love to invest their money within 90 days rather than investing their money for too long, because there's a lot of uncertainty. There can be inflation, there can be some political risk, etc. But in 90 days, someone will be compelled to invest shorter than to invest long, unless an individual is a risk lover. Therefore, all money market instruments are highly liquid due to shorter maturity. They have shorter maturity, meaning that their maturity do not exceed 12 months. Low return due to the presence of less degree of risk. Remember, risk and return. The higher the risk, the higher the return. Okay. Now, what are the money market instruments? Money market instruments are the following. Number 1, commercial paper. Number 2, certificate of deposit. 3, banker's certificate. 4, repurchase agreement. And 5, the treasury bills. Okay. These are the 5 most common money market instruments. What is a commercial paper? A commercial paper is issued by these corporations, can be a multinational corporation or domestic company, it depends. Remember in international trade, like here you have an exporter, right? You have an exporter, and this exporter has exported some goods worth 100 USD to a certain importer in the US. Okay. Now the exporter issues an invoice. The exporter issues an invoice which is accepted by the importer. The importer promises to pay an exporter within 90 days. Alright? Therefore, in his books of account, an exporter is holding a certain invoice which is worth 100,000 USD to be honored within 90 days from today's date. But for some reasons, an exporter is in need of funds, and he cannot wait for these 90 days to lapse before he could realize his funds from the importer. What he can do, he can go to the financial market and offer this commercial paper for sale. So at the financial market, you'll find investors. Alright? And investors can be individual investors or institutional investors. Whoever interested to purchase this particular instrument will purchase it. That means now, if the exporter is to offer this instrument at the market, then from investors, the exporter will get some money. Okay, will get some money. And he will release this document the commercial paper to an investor. On maturity, the US importer, when he honors this particular commercial paper, that fund will go to an investor who is currently holding that particular commercial paper. So you see, instead of this exporter to wait for 90 days before he could get fund through financial market, he can just get his fund tomorrow, maybe within a month, depending with the time or when he is willing to sell this instrument to the financial market. Then investors are the one who will wait to the maturity, and on maturity, once this instrument is paid, they will earn a certain interest following their investment. That's how commercial paper works. Another instrument is certificate of deposit. Now, certificate of deposit is a document that is issued by a bank to his customer, a customer who has opened a fixed deposit account and deposit their money. That is to say, if right now you have, let's say, 50,000 USD and you decide to open or to fix this amount with a certain commercial bank, call it XYZ commercial bank, for 6 months, at which on maturity you will be repaid back the 50,000 with a certain interest, let's say 3.5%, okay, on maturity. Then as the evidence of your deposit, the time deposit, XYZ commercial bank will give this customer a certificate of deposit. Therefore, the customer is supposed to wait for 6 months to lapse for him to be paid the invested amount plus what? Plus interest. That is principal plus interest. So he's going to have to wait for 6 good months before he gets paid. Now, same as in my previous example of commercial paper, for some reasons, this bank customer is in funding need. He wants some fund, quick. Instead of borrowing, which might be costful, and maybe he's going to need some collateral, and the loan might be expensive depending with the amount he's willing to borrow. But he can as well visit the financial market. Okay, he can as well visit the money market. So at the money market, he will find these institutional investors. Okay, certificate of deposit is highly liquid. He will find these institutional investors. He may find even individual investors. Okay, and what happens? What will happen is that this bank customer will release this certificate of deposit at the market, okay, where institutional investors will be willing to purchase it. That means funds will flow from institutional investors or from any other investors, okay, to the bank customer, and this instrument will go to the other side. That means the exchange. So, in conclusion, the bank customer will get money before the lapse of 6 months, whereas this investor will have to wait for 6 months to lapse in order to be paid. Alright, then we have banker's certificate. Okay, then we have banker's certificate. Now, what is a banker's certificate? For you to understand this, let me refresh your mind. on a certain bank instrument is called a letter of credit. Okay, remember a letter of credit, LC. Okay, a letter of credit has a minimum of 4 participants. Okay, an LC has a minimum of 4 participants. That is, on one side there is an exporter, and on the other side there is an importer. Then there is an issuing bank. Okay, and on the other side there is what? On the other side there is advising bank. Okay, now further let's assume that an exporter and importer has reached into an agreement whereby an exporter will export, all right? An exporter will export some goods which are worth USD 500,000. Okay, and an importer will make payments within 60 days after receiving goods. 60 days after receiving goods. That is when and only then he will make payments. Now they agree to use letter of credit for payments. That means now an importer will have to apply for a letter of credit at his bank. Okay, after applying for a letter of credit at his bank, the issue bank, upon raising the letter of credit, will notify the advising bank. Okay, notify the advising bank that a letter of credit has been issued. Then advising bank will further notify, this is number 2, this is number 3, number 4. The advising bank will inform an exporter that a letter of credit has been issued somewhere. Let's assume in US. Okay, and let's say here is Japan. The exporter is in Japan. Okay, a letter of credit has been issued in your favor. You're supposed to do 1, 2, 3. Now the exporter continues to send goods to an importer, compile all documents, and release those documents to the advising bank. Okay, so all documents are released to the advising bank. The advising bank forwards these documents to the issuing bank. Remember, the issuing bank is the one that's supposed to make payments. So documents are forwarded to the issuing bank. Now, since the letter of credit is supposed to be paid 60 days after receiving goods, you see, not on site, it's 60 days after receiving goods. It means if the bank receives these documents today, which is 1st of February 2023, if the bank receives these documents today, it will delay payments until the end of March. Okay, so in the meantime, what's going to happen? What will happen is the issuing bank will thoroughly inspect all the documents to ensure that it is a complying presentation. Okay, so after inspecting and be sure that this is complying presentation, what happens is that the issuing bank will accept, will accept these documents. So the document will be accepted. And after accepting these documents, they become bankers' acceptance. It becomes banker's acceptance. So if someone asks you how a banker's acceptance is generated, this is how it is generated. Therefore, an exporter will have to hold this banker's acceptance until 60 days have lapsed. Now, in case he is in funding need and he cannot wait for 60 days to lapse for him to get paid, he can take the banker's acceptance to the money market and sell it to any investor who is willing to purchase it. Since this instrument has been accepted by a reputable bank, then it is marketable. Any investor will be willing to take it. So an exporter can get his funds before the lapsing of 60 days. And then an investor will purchase this banker's acceptance, is the one who's going to have to wait for 60 days so that he can get paid. Another instrument of the money market is the repurchase agreement. Sometimes we call these repos. Okay, repurchase agreement, the repo. Now, look here, repurchase agreement. So, as the name depicts, here, what basically happens is that you have a certain investor, okay? You have a certain participant of the financial market who is holding a certain financial instrument, okay? This individual is holding a certain financial instrument. It can be a treasury bill, it can be a commercial paper, it can be a share certificate, can be any financial asset. Okay. Now, for some reasons, this individual is in funding need now. Okay, is in funding need now. So he decides to go to the financial market to sell the treasury bill. Okay. Now, at the money market, he meets another individual who is there to invest short, not long, is there to invest short. And they agree, okay, they enter into a contract. Now, what kind of contract? Please pay attention. Now, the contract goes like this. From this individual, he wants to sell the share certificate, okay, to this particular investor. Call her investor number 2, okay, and this one is individual number 1. Now, individual number 1 has a share certificate, okay, or has a treasury bill certificate. So he wants to sell this financial asset today, okay, and repurchase back the same financial asset after some few days, okay, let's say after 2 months, after 60 days, okay. He wants to sell the financial asset today. Today is 1st of February, okay, 1st of February 2023. He wants to sell this financial asset at, let's say, 10,000 USD. And he agrees to repurchase exactly the same instrument 60 days later. 60 days later at a price of, let's say, 11,000. Okay. So that is to say, for individual 2, the profit he will generate from this transaction will be the 1,000, which is the difference between 11,000 and 10,000 for holding this instrument for 60 days. If she agrees to enter into this deal, it means she cannot sell this instrument to someone else because there is a repurchase agreement here. There is a repurchase agreement. And what is the agreement? The agreement is today, the 1st of February 2023, she's going to pay 10,000 for this instrument and hold it for 60 days. So at the end of March, and then and only then, individual 1 will appear and individual 2 will sell back the same instrument to individual 1. That means individual 1 is going to repurchase the instrument that is sold earlier to individual 2. This is called repurchase agreement or repo. Now, last instrument that is traded in the money market is the Treasury bill. Ladies and gentlemen, whenever you hear the word Treasury, that is government instrument. All right? That is a government instrument. Okay. Treasury bill is considered as a risk-free financial instrument or financial asset. We do not expect for a government to default unless there is a very, very big problem. Otherwise, we do not expect for the government to default. Therefore, Treasury bill is risk-free. But Treasury bill is also known as a zero coupon bond. A zero coupon bond. Why a Treasury bill is called or is termed a zero coupon bond? Okay. Is called a zero coupon bond because with a Treasury bill there is no coupon payment. No coupon payment. What happened is a Treasury bill is purchased at a discounted price. It's purchased at a discounted price, but redeemed, okay, redeemed at a face value. So it does not pay coupon. Treasury bills are of different maturities, okay? Treasury bills are of different maturities. Okay. A moment, please. Maturities of the Treasury bills can be 30 days, can be 60 days, 90 days, 180 days. Okay, these are different maturities of the Treasury bill. Okay, Treasury bill can mature within 30 days. It can mature commonly within 90 days or 180 days. These are the maturities of the Treasury bill. Now, When a treasury bill, okay, if you want to compute the price for a treasury bill, you need to recall this formula. Price equals to coupon payment 1 plus R. This one can assist you to compute the price of the treasury bill. We discussed the commercial paper, certificate of deposit, banker certificate, repurchase agreement, and the treasury bill. Okay. Sometimes treasury bill can be used to determine the short-term interest rate. Short-term interest rate. Okay. Treasury bill is also known as the zero coupon bond. Okay. Its maturity ranges from 30 days, 90 days, 180 days, and 60 days. I forgot to insert it there. Okay. These are non-maturities of the treasury bill. A treasury bill is purchased at a discounted price and redeemed at a face value. Okay. Usually, the central bank will announce an auction. Okay. There will be an auction, and an auction takes place every Wednesday. Okay, every Wednesday in Tanzania. I don't know in some other countries, but in our country, every Wednesday usually will be the day for auction according to the BOT calendar. Now, before we move even further, I would like to share with you the treasury bill, and afterwards we're going to continue with the capital market. All right. Now here is the treasury bill auction number 1023, 1023. This one was issued by the Bank of Tanzania. It reads Treasury Bills Auction number 1023. Invitation to tender on the 9th of January 2019. Okay, on the 9th of January 2019. The Bank of Tanzania, on behalf of the Government of the United Republic of Tanzania, invites application through the Central Depository Participant, CDP. I'll explain to you what it means, CDP. Okay, so invites application through CDP to tender for treasury bills, which terms and conditions are as follows. Okay, therefore here we have terms and conditions for these treasury bills, and if you're interested, you are allowed to go and bid. Number one, the issuer. Issuer means the company or institution that is issuing a treasury bill. A treasury bill is a government instrument. It can never be issued by any other institution, like a private institution. It has to be the government. In most cases, the central government. Therefore, the issuer here is the United Republic of Tanzania, URT. That is the issuer of this treasury bill. Maturities. As I mentioned to you, treasury bills has different maturities ranging from 30 days all the way to 1 year. 1 year, that means 364 days. Okay. So in most cases, it's on quarterly basis. Treasury bills can mature in 35 days, in 90 days. Excuse me, here it's not actually 35 days. That is 5 days is an allowance for other paperwork, but commonly it's supposed to be 30 days. Okay, so that is an allowance. Otherwise, here I would say 30 days, 90 days, 180 days, and 364 days. So these are the different maturities. If that is to say, if you want to invest your money for 30 days, then you're gonna go for this one. If you want to invest for 90 days, then you're gonna go for this one. If you want to invest for 180 days, then you're gonna go for this one. And if you wanna go for a year, then you can invest on this amount. Auction date. Auction date is every Wednesday. So even this one's gonna be on Wednesday of 9th January. On this date, what will happen? On this date is when they will announce the winner. So usually this public notice is issued some days before the auction date for people to start bidding through the CDP. If right now you're interested to buy, to invest in this treasury bill, okay, you have to do this through your bank. Your bank is a participant of the CDP. Therefore, your bank is the one that will bid on your behalf. Your bank will serve as your agent. If you win, your bank will notify you so that you will authorize funds to be transferred from your account to the central bank account. That's how it works. So, to date, I don't think it is possible for an individual, just like you and I, to bid directly for this instrument. We have to bid through our banks. Procedure for bidding. Bids will be submitted online through CDP, and the process will be closed at 11 a.m. on the auction date. Remember, the auction date is 9th of January 2019, Wednesday. Now, auction results. Auction results shall be made available on the bank's website. The bank's website, the other day I told you, when you see banks in caps, it means central bank, okay? So the auction results shall be made available on the website of the central bank and at the CDP participants' offices immediately after the auction. Therefore, on the 9th, according to this announcement here, on the 9th of January is when they will close the auction, okay, and announce the winner. Then you'll have 1 day for settlement. Therefore, settlement date is Thursday, 10th of January. That is T plus 1. T is for auction date, that is 9th of January, plus 1, a single date. Another interesting information here is number 10, redemption date. Call it maturity date. Okay, so redemption date here, see, if you purchase a treasury bill that will mature in 30 days, okay, remember the first one is for 30 days. Now, the date for auction is 9th of January. So 9th of January, if you were to add 30 days, you're going to end up, or your maturity will be on 14th of February 2019. Here, you will get the fund that you invested. You will decide to invest for 90 days. Then they will have to wait until 11th of April. For 6 months, they'll have to wait until 11th of July. And for a year, they'll have to wait until the following year, 9th of January. Okay. So redemption date simply means maturity date. tax. Interest income is subject to 10% withholding tax. That is to say, the profit that we generate is taxable at 10%. The currency for investment is Tanzanian shillings. And what happens if you win, but for some reasons on the third day, 10th of January, you did not deposit money? Then you will be barred from participating in the next auction for 1 month. Okay. So if you do not transfer the fund as agreed, you won't participate in bidding for a period of 1 month, that is 30 days. Okay. So this is all about the Treasury bill. Well. Now let's see the capital market. Capital market simply means a financial market where financial instruments with a longer maturity are traded. That is to say, a capital market offers a platform for trading of financial instruments whose maturity exceeds 1 year. Remember, money market is a market for short-term maturing financial instruments. Okay, so the capital market is the opposite. This is the market for long-term maturing financial instruments. Capital market is intended to facilitate or to assist companies to raise funds to meet capital expenditure, that is, long-term funding needs, right? Therefore, all financial instruments that are traded at the capital market have super longer maturity. Maturity starts from 2 years and above. Okay. The capital market is riskier than the money market. Why? Due to the longevity of maturity of the financial instruments traded in this market. Okay. And again, this market yields higher return. Okay. This market yields higher return. Why it yields higher return? Due to risk. So the higher return simply means a compensation for the risk that the investor will incur whenever they invest in the instruments that are traded at the capital market. The capital market, as I mentioned before, is appropriate for a firm that wants to raise funds to meet capital expenditure or to finance a long-term maturing project. Okay, we call this capital expenditure. So that is to say, if a firm wants to launch a new product, okay, if you want to launch a new product, if a firm wants to purchase like real estate, plants and machines, then it can easily obtain funds from the capital market. So, what are the instruments traded at the capital market? Before I mention the instrument, I should remind you that all instruments traded at the capital market have longer maturity, has high risk, but also you can get some good return due to risk as compensation for the risk. Okay. Therefore, since these instruments have longer maturity, it means they are less liquid. It's very easy to sell the money market instrument than selling a capital market instrument. Financial instruments traded at the capital market are bonds, mortgages, and stocks. Okay? These are common financial instruments traded at this market. However, there are some other instruments such as debenture and syndicated loans. Okay. Debenture and syndicated loans. These are also some other types of financial instruments traded at the capital market. Debenture is an instrument that is issued by a company to acknowledge debt. Usually, it is formed when a company pledges its asset or charges its asset for a bank loan. Okay, is when we can form or we get the debenture. Again, we'll have a separate session where we will discuss thoroughly debenture and their types. So this is not a discussion for today. Syndicated loan. Syndicated loan, this is a kind of loan that is contributed by different investors. Okay. For example, we have a company that wants to borrow, let's say, 70 million USD. 70 million USD. This is too much of money for one company or for one bank to offer. The risk is too much. Therefore, if this project is worthwhile taking, a syndicate leader can invite some other commercial banks or some other institutional investors. Okay, so a syndicate leader can invite some other institutional investors to contribute into raising this amount. So you find, for instance, this institutional investor number 1 contributes a certain fraction, number 2 same, number 3, number 4, number 5, number 6, and number 7. Let's say they are 7. And each one of them contribute a certain percentage until they raise the entire amount, which is 70 million. So this one is called a syndicated loan. When the loan is repaid, every single investor will earn profit according to their contribution towards what? Towards the raising of that 70 million. The syndicate leader is doing so in order to diversify risk. Instead of granting or disbursing the entire amount alone, of which the risk will be too much just in case the loan is not repaid back, he decides to invite some other investors and share this profit. It's called syndicated loan. Mortgage. Mortgage is a loan or a financing to purchase real estate, for example, a house. The mortgage market is the one that led to the global financial crisis of 2007. It was due to collapsing of the mortgage market. Again, we're going to have a separate session where we'll discuss mortgages and debentures. So for today, I don't want to waste too much time over these two, mortgage and debenture. Stocks, also called shares or equity. Okay. What is this? Stocks or share. This is financial assets that offers partial ownership to the issuing company. Okay. A stock simply means a financial instrument that offers a partial ownership to the issuing company. That is to say, if you purchase shares of a certain company, you become a shareholder. You become one of the owners. You become one of the owners of that particular company. Your voice will depend with the number of shares that you have. Therefore, whenever you hear that somebody is a shareholder, it means they are owning a certain percentage of shares in the said company. A shareholder has some rights as toward the company. Okay, a shareholder has some rights towards the company. And what are the rights? Shareholder can attend company meetings. Okay. Shareholder can attend company meetings. Shareholder has a right to vote on important matters of the company. If the company wants to make some major decisions regarding the business or recruitment, a shareholder has a right to vote. A shareholder receives dividend. Okay. A shareholder receives dividend at the end of the financial year if the company has made profit and decides to offer dividend. Sometimes a company can make profit but decides to retain all the earnings due to some other reasons. Of course, the reasons might be shared, might be communicated to all shareholders for them to comprehend. But if the company decided to issue dividend, then every single shareholder will receive dividends according to the percentage of shares. Okay. When I say percentage, that is, if the company has offered, let's say, a total of 10,000 shares, okay, and you have 200 shares, then your percentage, you have to take 200 shares over 10,000 multiplied by 100. So from here, you'll be able to tell your percentage. That means you have 2%. You own 2%. Now, shareholder, these shares has a value. Okay, remember shares are traded at the financial market. Shares has a value. Let's say when you first purchase during the IPO, when you first purchase the share, you purchase a single share at 10 USD. Okay, 10 USD per share. Okay, therefore, if you have 200 shares, okay, then you have to take 200, you multiply by 10 USD. That will be 2,000. So your shares are worth 2,000. And actually, the moment you purchase the share, you will be given this share certificate. Shareholder certificate to identify. Okay. So it will state your names here, so and so and so, owns shares of XYZ company. Then the number of shares will be stated over there. And finally, the price. Okay. But actually, maybe the certificate will contain only the initial price because share price fluctuates. Shares are also volatile. So if the shares increase in value, and so will be the value of your shares. For example, you purchased 200 shares, each at 10. That means you paid 2,000. And after 3 years, the shares, the value of one share for the same company is now 30 USD. Now, if it's 30 USD, it means now your shares are worth what? 60,000. So the value of your share has increased. Now, you may decide to sell your share. If you sell your shares at a value which is greater than the purchasing price, you'll get what? You'll get capital gain. Okay? You'll get capital gain. Capital gain is obtained when you sell shares at a price that is greater than the purchasing price. Okay, there is where you get capital gain. So that is to say, you purchased one share at 10 USD, and then you come to sell it. This is when you buy. Then you come to sell one share at 25 USD. So the capital gain here is 15 USD per share. But also, you may end up with capital loss. Capital loss is when you sell your shares at a price that is lesser than the purchasing price. For example, you purchase a share at a price of USD 10 per share, and you decide to sell, and now you sell when the market value for your share is 8 USD per share. That means you're going to get a capital loss of 2 USD per every share. In case a company is in a petition for winding up, the company is bankrupting, then shareholders are in the least ranking of being paid. When the company is being winding up, the company, for example, is bankrupt, then after the liquidation process, once the liquidation process has completed, once all the assets have been sold, they'll start paying government taxes, if any, levies, etc. Then some other creditors have preferences over shareholders. So shareholders are the last. That means if it happened that there's some more creditors, a lot of debt, most likely shareholders won't get anything. Okay? Because shareholders were involved in management process. They have right to vote and to make some decision, important decision of the company. Therefore, if the company is collapsing, they need to feel pinch for their actions. Now, let's see bonds. Unlike share, bond is a debt instrument. Okay? Bond is a debt instrument that is issued by a company when it wants to borrow money. Okay? When it wants to borrow money from the public. Share is an equity instrument. Okay? This is an equity. And for the first time, shares are issued during the initial public offering. Okay. Now, as for the bonds is a debt instrument issued by the company whenever it wants to borrow. Okay. Now, a bondholder A bondholder has the following rights. Okay? A bondholder has the following rights. Number one, bondholder will receive coupon payment. Okay? Bondholder receive coupon payment until maturity of the bond. A bondholder cannot attend meetings of the company. A bondholder has no voting right. However, if the company has bankruptcy, is being winded up, the bondholder has preferences for payment. As a matter of fact, in case we are to compare, if we are to compare a bondholder and shareholder, okay, then a bondholder will be paid first before the shareholder. Now, I want to explain to you something about the bond. A bond have a face value. Okay, a bond has a face value. Let's assume 20,000. A bond has maturity. Okay, a bond has maturity. Let's say 3 years. A bond pays coupon payments, but coupon payments is calculated from a given coupon rate. Therefore, a bond has a coupon rate. Okay, let's say a coupon rate for this bond, for the 3 years bond, is 10%. Then a bond can have a bond price and bond have coupon payment. Okay, these coupon payments are also known as interest payment. Interest payment. So these are the payments that will be that the bondholder will receive until maturity of the bond. For example, now, if one of our friends have purchased a bond that will mature in 3 years, okay, and face value is 20. This face value is the principal amount that you as an investor need to invest. Okay, you need to pay for this bond. Now, if the face value is 20%, is 20,000, and the bond has a coupon rate of 10%, it's very easy for you to compute coupon payment. Okay, it's very easy for you to compute what? Coupon payment. Actually, basically here, the coupon payment will be 20,000 multiplied by the 10%. Okay, 20,000 multiplied by 10%. Okay, therefore, if you do so, you're going to end up with what? With 2,000. Therefore, if you're a bondholder holding this bond that will mature in 3 years, I want you to understand one thing. The coupon payment, a bond pays coupon payments, okay, until maturity. But the coupon payments are payable every 6 months. Okay, after every 6 months, you'll get what? You'll get this coupon payment. So it's on semi-annual basis. Alright. That is to say, if the coupon payment is 10% per annum and the bond pays twice in a year, then the interest rate here needs to be divided by 2. Therefore, semi-annual payments will be 1,000. Now, this is how it works. Let's assume that our friend today our friend has purchased a bond. Okay, today is the 1st of February 2023, and one of our friends purchased a bond that will mature in 3 years. So 3 years from today, it means this bond will mature in 2026. Now we have seen here that this friend of ours will be receiving coupon payments payable every 6 months until maturity. So that is to say, now we are in the year 2023. Now 6 months from now, today is February, okay? Today is February. So 6 months from now, that will be August, okay? Therefore, in August, he will receive the first coupon payment. Then in 2024, in February, he will receive the second coupon payment. Again, in August, he will receive the third coupon payment. In 2025, February is going to receive the fourth coupon payment, and in August is going to receive the fifth coupon payment. Then in 2026, February 2026 is going to receive two things. First, he will receive the final coupon payment, and he will receive the principal amount he invested. Okay. Therefore, the profit this individual will generate from this investment will be the summation, okay, of these coupons. So coupon 1 plus coupon 2 plus coupon 3 plus coupon 4 plus coupon 5 plus coupon 6. And again, at the end of the day, on maturity, he will receive the principal, that is the amount that he invested into this bond. Now, on this example, I say that this bond has a face value of 20,000. That means the principal invested here is 20,000. And we made some computation to obtain that the coupon payment will be 1,000 every 6 months. Therefore, 1,000, 1,000, 1,000, 1,000, 1,000, 1,000. That is to say, from this investment, this friend of ours is going to get a profit of 60,000, and on maturity, he will receive what? His principal, which is 20, therefore totaling 26,000. This is how the bond works. Again, at any given moment, someone can ask you to compute price for the bond. The formula is going to be summation of cash flow one plus R. Excuse me. Okay, so someone can ask you to compute. Someone can ask you to compute bond price. That will be cash flow 1 plus R, okay, plus cash flow 2 1 plus r power 2 power 1 plus blah 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 cash flow n. So cash flow 1, cash flow 2, cash flow n, 1 plus r power n plus principal 1 plus r power n. That's how you get the bond price. Therefore, if you have the coupon rate, if you have the face value, the principal, you can easily compute a bond price. But if you have bond price, you have principal, you have cash flows, okay, you are asked to compute the interest rate paid by this bond, then it's going to need you to use a financial calculator. It's very difficult mathematics. To sum up, I want to share with you a bond announcement. Okay. All right. Now, this one again is a bond that was issued by the Bank of Tanzania on behalf of the government of United Republic of Tanzania. So it reads 15.95, okay, 15.95 25-year fixed rate treasury bond. Okay, the auction is to be held on 19th of January 2022. An opportunity to invest in the Republic of Tanzania, 25-year fixed rate treasury bonds. The Bank of Tanzania, as a fiscal agent for the United Republic of Tanzania, invites bids for the reopening of the above bond, which was issued on 25th of April 2021. Terms and conditions for these bonds are as follows. Issuer, the United Republic of Tanzania. That is the institution that is issuing this bond. So this is the government. Amount is stated. Okay. Bidding procedure, you have to bid through the CDP. Okay. Auction date, 19th of January. That is the date they will announce the winner of this bond, of this auction. Settlement date, this is the date that you suppose, if you're the winner, you're supposed to release funds into the central bank. So it's one day after the announcement. Just like before, auction results will be published on the BOT website as well as on the CDP. Interest payment date, okay, interest payment date. Remember I told you a bond holder receive coupon payments payable 2 times in a year, that is every 6 months. Therefore, if you are going to win, okay, if you're going to win this bond on 20th, you settle, you make settlement. All right, it means 6 months is from this date is when you receive your first interest payment. Now 6 months is from January, that will be when? It's supposed to be 6 months is from January, that will be July, right? Yes. 6 months from January, that will be July. Okay, so here it says semi-annually from the issue date, that is 21st of October and then 22nd of April. I think something was wrong with the computation here, because 6 months from January is supposed to be July, okay, and not October. October, that is almost 9 months. So if 9 months had been correct, then from October, 9 months cannot be April. This is the problem of copying and pasting. Okay, let me confirm this theory with another bond. I have another bond here. Okay, this is 20 years bond. Settlement date 24th of November. which means 6 months is, okay, 6 months is supposed to be when? November, December, January, February, March, April, May. Yes, so 6 months is, that's going to be May. Yeah, you see here, interest payment, first interest payment, May. Okay, then second interest payment 6 months is later, that's going to be November, same as the settlement date. All right, and the maturity needs to be November, okay, 20 years later, because this one matures in 20 years. So maturity is this one, you see, redemption date, maturity November 24th, 2042. That is when this bond will mature. Therefore, on this one, there was a problem here. Okay, this is wrong. This is wrong. Copy and paste. Everyone makes error, so we forgive them. Okay, because here interest payment, it reads semi-annually from the issue date. Now the issue date, when was the issue date? The issue date is 19th of January. Therefore, if the issue date is 19th of January, it means the first coupon payment have to be paid 6 months afterward. That will be July. Okay, that will be July. Now, since this one is long-term maturing instrument, it is exempted from withholding tax. Okay, this is the advantage of investing in treasury bond. Okay, you are exempted from withholding tax. That is to say, these interest payment are non-taxable. Okay, redemption date 22nd of April, is supposed to be January 2046. So if you are interested in investing in this bond, okay, how many coupons are you going to receive? And for some reasons, if you decide to invest Tanzanian shillings, let's say 10 million, okay, if you invest 10 million in this bond, okay, a bond that has a coupon rate of 15.95, okay, the coupon rate is 15.95 per annum. It's written down there. Okay, you have to be careful with this. 15.95 per annum. Okay, it's right here. So you need to divide this by 2 because coupon payments are payable twice in a year. Okay, now you can do the computation for you to get what? The coupon payment, because you have coupon rate which is 15.95. Then how many coupon interest, coupon payment or interest payment are you going to receive? That will be 2 times 20 years, that is 40. Okay, so you're going to receive 40 coupons. If you compute the very same way I did earlier, you will know how much you'll be receiving until maturity if you are to invest 10 million today. And again, remember, on maturity, they will pay your last coupon plus what? Plus the 10 million that you invest. So I can quickly do this one for you here. If I'm to take 10 million multiply by 0.1549, sorry, 0.1595. Okay, I'm going to end up with 1,595,000. Now divide this by 2. Okay, divide this by 2, you're going to get 7,797,500. Okay, this is the coupon payment that will be receiving on semi-annual basis every 6 months if you are to invest 10,000 on this bond. Now, since you're going to receive a total of 40 coupons, okay, Since you're going to receive a total of 40 coupons, then you need to multiply this amount by 40. Okay, if you are to multiply this amount by 40, okay, you're going to receive 31,900,000. Okay, this is what you will receive, 31,900,000. And again, on maturity, that is 2040, you will receive back your 10 million that we invested. So you can see how profitable this instrument is. Highly profitable. But you're gonna have to wait, okay, until 2046. That is 20 years. It could be a very good legacy for your kids. Gentlemen, ladies, this marks the end of today's session.